All right, I can see people joining. We're going to give this a minute or two. All right, let's start then. Welcome to all our attendees, and thanks for joining us today. I hope it's going to be an insightful session on what's going on in freight markets. Now, a year ago, I was certainly part of the majority that believed or hoped that we'd be much closer to seeing an end to this global pandemic. Now I believe I'm a bit more realistic or resigned even, and we'll probably have to wait longer for a return to normal. And that's exactly the parallel I want to draw here with freight markets. We believe here at Vortexa that market participants should be careful with hope and look at the data presented in front of them in order to take informed commercial decision. So without further ado, let's kick this off. My name is Arthur, and I'm the lead freight analyst at Vortexa, and I'm joined today by my colleague in freight analysis, Yanis.
Thank you, Arthur. Glad to be here with you to analyze the current and future state of the tanker market.
Cheers, Yanis. So a bit of housekeeping before we start. The length of the webinar is going to be approximately 40 minutes, with about 30 minutes of presentation and discussion, and then 10 minutes of Q&A. You can send through your questions to the chat section as we go through this webinar, and we'll aim to answer as many questions as we can at the end of the presentation. Regardless, everyone will receive a recording of the session and slides via email at the end of the day. So today we'll be covering the following topics. We'll start off with a quick overview of some key global indicators to get a feel of what the big picture is telling us. We're then going to move on to crude flows and freight markets, followed by refined product flows and freight markets. And we'll go over what we believe are some unique insights from our own analytical capabilities before concluding with some key takeaways. So let's take a look first at a few big picture indicators that might provide some indication as to where energy seaborne markets might be heading before we do a deep dive in the data. So on the left-hand side, you'll find a chart from Our World in Data. It's an online scientific organization that tracks vaccination levels against COVID-19. Now, the reason this is important for our webinar today is really because we believe that the global economic recovery is hugely dependent on vaccination rates. Now, make no mistake that even if your closest Pret is open and you've been able to go back to some of your old habits when it comes to consumption and traveling, we're still a long way off from where we were before this pandemic. And this is really one of the most single important data sets to track, as we've seen how resurging waves in countries like India and the current lockdowns in Southeast Asia impact the recovery. So even if we look at the more developed economies as a whole, we've barely given one jab to half of the population. The European figure here does include Russia, for those of you wondering. But again, we have much higher vaccination rates in Western Europe compared to Eastern Europe, for example. And it's going to take some time, and that will directly impact freight markets. On the right-hand side is a collection of oil demand growth forecasts from the IEA, the EIA, and OPEC. So when it comes to the latter, they have an initial bullishness. It's worth mentioning their predictions are more political in nature, but even now they are being questioned. Demand only grew about 3 million barrels per day for the first half of 2021, and we're quite far away compared to that near 6 million barrels per day figure. Now we're expecting oil demand to breach 100 million barrels a day in the second half of 2022. Now, whether that's a realistic assumption or not, and whether freight markets should be hopeful that a recovery that keeps getting pushed back is around the corner, is what we're going to find out now. So throughout this webinar, we're going to be combining both our flows and freight insights, as it's really the combination of those two proprietary data sets that's going to allow us to generate the greatest value. So we're going to start off with crude markets. Looking at global crude loadings by main supply region on the left-hand side here, you can see it really speaks for itself. You can still see that significant dip from let's say April, March 2020 onwards, and the fact that the level has been more or less maintained since at about 37.5 million barrels per day currently, even down marginally in August by about 160,000 barrels per day. And we believe there's little potential for this to rise in the near future. Now, loadings from the Middle East are up, unsurprisingly, by about 1.4 million barrels per day after June lows. We have seen supply constraints easing, but that's largely offset by the lack of increase from other regions. So we're going to be talking about West Africa, which really deserves its own slide. And we also have the former Soviet Union countries. They're currently at a 7-month low, though we estimate those to be more transitory in nature. Now, what that means for freight on the right-hand side is really that low levels of loadings means less ton miles. So in other words, less tanker demand for crude tanker markets. And that's really evident from this chart. I think what's really striking is not the fact that we remain down from 2019 levels, as seen by the yellow line here, but really the fact that we're practically at the same level as we were in September 2020. So a recovery before the year end and a bullish Q4 2021 really won't materialize. And we're expecting a flat, if not further depressed market for the rest of the year, frankly. Doing a bit more of a deep dive into OPEC countries. So we just saw that Middle East volumes of crude were more or less flat in appearance, having even risen slightly. But if you look behind the scenes, you can really see two dynamics at play. So on the left-hand side, you'll see exports from Saudi Arabia and the UAE. You can see they're continuing with their provision of steadily growing crude volumes to the market. If sustained for the remainder of the month, as the September figure here is only really up to 20th of September data, that's going to be the second month in a row where not only the year-ago figure is outpaced, but also the respective month of 2019. However, when you take out Saudi Arabia and the UAE, it becomes evident that the group as a whole really fails to increase production as supply allocations would suggest. And that's really key to bear in mind. So while quotas have called for an output increase of about 1.2 million barrels per day since April, seaborne exports have actually declined by 1.8 million barrels per day. So that's a massive 3 million barrels per day mismatch. And when comparing recent exports of 15 million barrels per day with the level in early 2018 of about 22 million barrels per day, we've got a loss of 7 million barrels per day here, which is really becoming evident. So supply limitations, such as the ones presented here, are going to continue, well, successfully supporting prices, but also fail to really kickstart an ailing crude tanker market. Now we've looked at the export side. We're going to now take a look at the import side. And I don't want to point fingers, but there's really one culprit here that does have an outsized influence when it comes to crude tanker markets. And that remains China. So China actually announced last week it had fully vaccinated more than 1 billion people, or 70% of its population, which is a pretty incredible feat. But it remains what I would call a pragmatic buyer. And as the price of crude inches higher, we can really see the trend following China's crude arrivals. But that doesn't really explain the whole story. We've also got really high crude inventories that continue to be drawn upon, that were built in 2020. And that's capping any further upside to crude imports. Our data actually, coupled with data from the National Bureau of Statistics, estimates about 1.25 million barrels per day entered storage on average in 2020. And that's really a formidable sort of buildup of reserves upon which to draw. Now, there was the recent announcement that China will sell some of its strategic reserves, which might further limit imports, but the amounts are not that important for us to see that as really significant. But it is an interesting move. So those limiting import quotas that are in place as well, that the Chinese government put in place to sort of clamp down on excess refining capacity, really is the final nail in that coffin for now. And we're really seeing that in a stark way with VLCCs on the right-hand side. So about 9 months ago in Jan, we had about 160 VLCs loaded with crude heading to China. And that number stands at about 80 today, which is a mind-boggling, really, 50% drop in utilization levels on a unique vessel count. And as we saw, we've seen the situation in the Middle East, but it's really drops in the US Gulf and West Africa that have sort of exacerbated that drop in ton miles. And we're going to take a look at the latter. So West Africa. I feel like I need to apologize for continuing to add what's really turning into a pessimistic outlook, but there is a region that's being ignored. I'd like to bring the spotlight to West Africa. It's easy to forget what a sort of really powerful engine of crude tanker markets West Africa is. And what we're seeing in the data really paints a dire picture. We had in August 2021 about 3.14 million barrels per day loaded, which is the lowest monthly total we've ever seen here at Vortexa. So since January 2016. You don't have a lot of significant new upstream projects expected to come online in the region. That comes against a sort of wider backdrop of a weak global investment appetite in oil and gas production. So the outlook for West African crude production and hence exports, hence cargoes for tanker markets, also looks bleak. So that really indicates it's more than a passing fad, basically. It's really a sort of structural decline. If you look at the two data sets on the left-hand side there on the chart, you can really visualize sort of figurative hammering of rates by the monthly variance, the monthly decreases of ton miles compared to their 2018 baseline. There's one project that deserves our attention, and that's the much touted Dangote refinery. So yes, it has yet to become operational. And yes, I also don't believe it's going to be running at full refining capacity from the get-go. But even if we estimate that refinery to run at about 50% capacity, we're going to be looking at about 350,000 barrels per day. So that's 2 Suezmax or 1 VLCC equivalent cargo out of the market every week, on top of all of the region's export declines. So we've got this slightly continuation of recent trends that would put West African OPEC supplies less than 700,000 million barrels per day by the end of next year compared to Q1 this year. So if you add the current OPEC allocations that are at the same level, 700,000 barrels per day, you've now got this gap of 1.4 million barrels per day of missing barrels. If you add the ones planned for domestic consumption, due to the Dangote refinery, we're talking about now 1.75 million barrels per day out of the market. So from a ship owner's perspective, that sort of demise in West African supply really constitutes one of the key reasons behind those terrible earnings. And that's probably only second to COVID-19 repercussions. And we believe it has even more of an impact than the potential loss of dark shipments of that we're going to be exploring later on. I'm now going to hand over to Yanis for the second part of this webinar.
Thank you, Arthur. Hopefully, I'll try to paint a more colorful picture on the clean product tanker market. So firstly, let's start with a top-level approach to investigate the factors that have mainly triggered clean product demand throughout this year. By looking at the graph on the left-hand side, we can deduce that the recovery from the pandemic is coming at a different pace regionally. Driving mobility data which directly impact transportation demand saw a staggering increase throughout the summer of around 70% to 120% in regions like US and Europe when compared to the baseline of January 2020. On the other hand, for regions like Asia, for example, where COVID case resurgence brought back travel restriction and lockdown measures during the summer, transportation demand has not yet picked up, but on the contrary, has remained flat from the same baseline. This development had a direct impact on clean tankers. As you can see from the chart on the right, when looking at ton-mile demand for clean tankers, there is a contradicting trend since the start of the year. We're seeing a continuous increase in ton miles towards the west of Suez, which is estimated around 33% since the start of the year, at the expense of ton miles towards the east of Suez. Hence, we're looking at more and more vessels offloading west instead of east, quite contradicting to what we were experiencing during the start of the year. And that makes absolute sense, as the Western Hemisphere was under strict lockdown measures during December and January of 2021, while on the other hand, the situation in Asia countries had ameliorated. So going to the next slide, we touched upon where these tankers are offloading their cargoes, but we haven't talked about where these tankers are loading from. And to do that, I firstly want to focus on the recent developments of the product landscape in Asia. So during the summer, we had implementation of limited product export quotas in China, which is reflected in our data for June, July, and August, while preliminary data show a slight improvement for September, but nowhere close to Q1 or early Q2 levels. On the other hand, we are looking at an increase in product exports from Japan, which stepped in to fill China's void. Also in India, refineries have been ramping up crude runs to meet rising gasoline demand. However, diesel demand has been lagging as industrial and construction activities have not yet recovered. Thus, India's clean product exports have been rising since July, mainly due to these diesel volumes that are headed for export. Now, from this slide, we can see that clean tankers ton miles from the east of Suez have reached an annual high, triggered by diesel demand from the Atlantic basin, as you can see from the left and the right-hand charts. But how did this development occur? So first of all of these increases in Asian exports, which we explained in the previous slide, have occurred at a time of limited product demand in the Eastern Hemisphere amid COVID restrictions. Now, conversely, in the West, we are looking at the strength in diesel prices in regions such as North America and Europe. And this has also been evident in Latin America, mainly because of two reasons. Firstly, the harvest season in Latin America commenced during our summer months, which correlates with strong diesel demands as many of the agricultural equipment use diesel. And secondly, a part of power generation in Brazil is stemming from hydropower, but because of record droughts in the country, a portion was fulfilled by diesel. Now, another change in trade flow pattern was that during the so-called US driving season, and even prior to that, gasoline towards the US was satisfied by Europe. Hence, activity was focused on the west of Suez, especially for transatlantic movements. However, during the end of the summer, we saw more diesel and gas oil cargoes doing the east to west of Suez route, and this ultimately increased the distance traveled. This also partly has to do with the faltering Russian diesel exports towards Europe and limited Path 3 exports towards Latin America, as some refineries in Louisiana have remained shut after Hurricane Ida and Nicholas landfall. So, of course, this rise in diesel demand had an impact on freight rates, and that's true for all clean tanker segments, as we can see from the two graphs on the left-hand side. LR1 and LR2 tanker earnings for the ME, so Middle East to Europe benchmark route, which is dominated by diesel cargoes, increased by 35 and 15% throughout August, respectively. At the same time, MR earnings in the Pacific during the last month have also risen at the expense of Atlantic basin earnings, which further plummeted, as you can see. Of course, we're talking for a slight improvement on the Pacific rates, especially regarding MRs, where owners' earnings remain at multi-year lows. Now, unfortunately, looking ahead, the situation does not look encouraging for ship owners for both the supply and the demand side, which will likely lead to a further deterioration in rates. First of all, on the supply side, the weakness of loadings from west of Suez has forced vessels to seek employment towards the east, which eventually has capped rates as we have seen them declining during the past week. And as more and more vessels will compete in the Eastern Hemisphere, we expect to see further pressure exerted on the vessel supply side. Now, at the same time, on the tanker demand side, things look also gloomy for owners as a prospective increase of refinery runs in the west of Suez, mainly in Europe, will likely slash ton miles. The diesel demand picture also from Latin America does not look encouraging either for the long run. This is mainly as well for two factors, as we explained earlier. First of all, harvest season in Brazil ends in October, And as agricultural activity subside, we will likely see a reduction in diesel consumption. At the same time, we're already moving into the rainy season in Brazil, and hence we expect to see a decline in diesel imports from the country as power demand will be satisfied for hydropower. Now back to you, Arthur, for the unique insights.
Here I was thinking you were going to finish on a more positive note.
I really hoped I did.
So when it comes to the third part of this presentation, I hope we're not considered so bold, with our title, but we've really been uncovering some super interesting trends, either known or unknown, and if known, not explored to the depth allowed by our data today. So we're going to share a couple of those with our audience here today. Looking at the shadow oil trade. So a couple of weeks ago, a listed tanker company declared plain and simple, shipments of US sanctioned crude are now at a scale so large, it's distorting the global oil market, hurting tanker freight rates, and displacing compliant oil. And they were not the only ones. Their comments were echoed by two other listed tanker companies. So here at Vortexa, we decided to investigate that statement. And what you see here are the results of our investigation. What have we found out? So it comes as no surprise. On the left-hand side, you can see the timeline with OPEC sanctions. They have had the intended effects. It's evident that we had a really strong drop from the height of Q2 2018 there, where we had about 3.6 million barrels per day of crude exports, if you combine Iran and Venezuelan flows data. But what's more interesting is really what's going on the right-hand side of that chart. And that's the evident pickup with a record Q1 2021 of 1.3 million barrels per day on the water of sanctioned barrels. Now, whether from a global perspective one considers this number as distorting is another issue, but there's no denying the size of this trade. And also from a shipping point of view, where from a utilization percentage of total fleet, and here we've combined VLCCs, Suezmaxes, and Aframax tankers. So we estimate 4% of that combined global fleet is utilized in this trade today, with some segments more involved than others. And one area of the freight market where this is having an outsized impact, without a doubt, is when it comes to scrapping of these vessels. So as we can see from the chart on the left there, old VLCCs, so here we're looking at aged 15 to 30-year-olds, and yes, you have vessels that are that old on the water today, utilized for what we define as dark voyages. So that's anything involving Iran, Venezuela, or likely to involve Iran and Venezuela. And you can clearly see two spikes in recent history. So the first one was during the end of 2019, sort of start of 2020. That was caused on the back of elevated VLC freight rates due to COSCO sanctions, which prompted the usage of that older tonnage. So that was at the expense of newer, more expensive freight, but also because of limited supply from Saudi Arabia after drone attacks on Aramco refining facilities at the time. Now, more recently, we've also experienced an increase in VLC utilization throughout 2021, as Iranian barrels were provided at a discount to other regions, at a time where crude oil prices were surging across the board, really, and OPEC plus supplies were limited due to the cuts we previously mentioned. So why are old VLCs involved in these trades? Well, the main reason is they have a smaller economic life, hence the risk of getting sanctioned really impacts them a lot less. It impacts the owner at a lower degree. And another thing to note, obviously, is the money involved, is really the premium for carrying that oil, carrying those Iranian or Venezuelan barrels. We've heard rumors in the market that you would be earning 10 times more if you were carrying those cargoes. So essentially, it's a scenario of high reward, low risk for these owners. And with these vessels utilized on those trades, they're not heading to the scrapyard. Even though you can see on the right-hand side, scrapping prices are actually at 10-year highs. And from 2019, till today, only 9 VLCCs have been scrapped, which is really a tiny amount when looking at the 32 that were scrapped in 2018. So this limited scrapyard activity has kept over tonnage in the market. It really dampens any sort of freight rate recovery. And in our opinion, that is only going to change if sanctions are removed, which will make that premium disappear, and which is going to really make the use case for these VLCCs to disappear as well. Back to you, Yanis, now for unique insights in the clean market.
Thank you, Arthur. So let's proceed to another topic of equal importance. A trend we have identified as Votexa is the increase in VLCC maiden voyages carrying clean cargoes. So as you can see from the chart on the left, in 2021, clean product volumes carried on newbuild VLCCs have surged when compared to 2020 levels. The driving force responsible for this uptake of diesel cargoes is the currently depressed crude tanker market, as you said earlier, Arthur. This, of course, allowed charterers to benefit from the low freight rate environment of VLCCs or even Suezmaxes as well, as the economies of scales these tanker classes provide. An interesting observation also that underlines actually the subdued crude freight environment is that in 2 instances, Suezmax tankers and once a VLCC were utilized for more than 1 clean cargo voyage. Even though this is quite infrequent, it is technically viable for newbuild uncoated tankers to ship clean cargoes, but only for a handful of voyages to avoid hull corrosion. Of course, these developments have cannibalized the MR and LR2 tanker segments, which otherwise would have carried these clean cargoes, right? To put it in numbers, in 2021, around 10 million tons of clean products, mainly diesel and gas oil, have been carried on crude tankers. This corresponds to around 85 to 120 LR2s. But as the main destination of these cargoes is West Africa, MRs is a main segment that bears the brunt of this development. Now, the next question that needs to be addressed is whether this trend of clean cargoes on crude tankers will continue. So far, we need to say that 15 out of 27 VLCCs delivered this year carry the clean cargoes, which corresponds to a 56%. And additionally, 2 VLCCs that hit the waters recently are awaiting in STS zones in the east of Suez, where diesel cargoes are often loaded before moving westwards. Apart from that, 7 VLCCs are expected to enter the market for the remainder of the year, which is considerably less than the numbers achieved so far. However, current dynamics continue to signal a weak crude freight landscape. As said earlier, import demand from China remains limited, and while on the supply side, scrapping activity is subdued, as we mentioned earlier. So these 2 pillars will likely continue to exert pressure on crude tanker employment and hence freight rates, setting the appropriate conditions for clean maiden voyages on crude tankers to resume. Finally, it should be mentioned that this relative strength between CPP and crude flows is also triggering a dirty to clean shift for Aframax and LR2s. So the reason for that shift is purely economic as well. The shift has commenced since the second quarter of 2020, where we saw the difference in earnings between LR2s and Aframaxes reaching even $50,000 per day. Since then, clean dirty earnings spread has narrowed, though LR2 earnings are still consistently outperforming their dirty counterparties. Similarly, 2-year time charter rates indicate that LR2s are poised to fare better than Aframaxes, as you can see from the white bar charts, bars in the chart. This shift is poised to have an upward impact on tanker rates by alleviating the Aframax supply side, at a time though where LR2 rates had an upward momentum during the summer, which can be essentially capped from the continuous increase in tonnage that is competing for the same cargoes, especially in the naphtha trade. Now back to you, Arthur, for the key takeaways.
Cheers, Yanis. So we've come to the end of our presentation. Before we open up some time for Q&A, let's circle back to some of the key messages I wanted to share with you today. When it comes to crude markets and their impact on freight tanker markets, demand is going to take a while to recover, probably not before the second half of 2022. And at the same time, supply is actually a lot tighter than we believe the market knows. So these are really two negatives. VLCs and Suezmax tanker segments are really going to bear the grunt there, whereas Aframax, tankers may benefit from some regional arbitrage opportunities or some pickups there between, especially transatlantic. But overall, because of the continuing global pandemic, we're not seeing any sort of positive news in the tanker markets, at least on the crude side, until 2022. Yanis, do you want to share some of your takeaways for the refined product markets? I think you may be on mute there.
Flows to east to west of Suez flows with elevated ton miles essentially. However, vessel tonnage list building towards the west, prospective elevated refinery runs in the Western Hemisphere and weaker diesel demand fundamentals would probably cap freight rates and will keep earnings at multi-year lows. To top it off, the weaker crude freight market will continue to incentivize VLCCs to perform clean cargo maiden voyages, essentially eating away MR employment. Back to you, Arthur.
Thank you. So last but not least, regarding our other insights, sanctioned barrels should absolutely be taken into account to the tune of at least 1 million barrels per day of seaborne crude, according to our data. And in turn, that's going to continue to fuel overcapacity as illicit trading provides strong incentives and good opportunities for earnings for older VLCCs. And finally, there's a gloom crude freight environment, as we mentioned, that's forced more LR2s to switch to clean. So that's effectively increased vessel availability for cargoes on LR2 tankers. And that might provide some respite for Aframax tankers as they see less competition there, further supporting the idea that regional trades for Aframax tankers might be the only really bright spot. So now we're going to open up for the Q&A. Thank you everyone for listening. I see we've already got a few questions in the chat. Yanis, do you want to start with the first one?
Yeah, I can start with the first one. I see we have one here, which is what are the prospects for the US Gulf Aframax market? Yeah, that's actually a really good question. Well, I can say I'm kind of torn in the middle regarding this market. As said beforehand, the current demand situation in the east of Suez is ailing. So we're expecting Aframaxes to seek employment towards the west, kind of pressuring the supply side in Aframaxes. And, we're already seeing also crude exports in the US faltering on the back of lower crude inventories, and especially after the hurricane impact. There was also, I think, an announcement from Shell that Mars and Arsa fields will be offline till the end of the year, if I'm not mistaken. And, this essentially will eliminate some barrels from the market. And, because of this, though, the silver lining is that we might see more crude from Latin America heading towards the US, supporting actually Aframaxes for this route. But on the other hand, we might see runs in Europe increase as some refineries, start to ramp up operations again in the region. But this demand is likely to be satisfied from Middle East and Russian barrels, which are on the verge of ramping up crude production. So we're expecting less employment on Aframaxes on the US Gulf to Europe route. Now on the supply side, as LR2s are cleaning up, as we said earlier, we're expecting lower competition on the one hand. However, Aframax deliveries, according to latest data, are expecting to reach a 3-year high, with a third of them in the pipeline to hit water in the remainder of the year. So yeah, sums it up, I think. Back to you, Arthur, for the next question.
So we have a question from Vivek here. What is the latest on when that refinery in Nigeria is going to start operations? That's kind of the question that everyone's been asking. It was planned to start in 2020, so obviously that hasn't happened. I think now the latest news, that date from August of this year, whether it would start commissioning at the start of 2022. So let's see whether that happens or not.
Thank you. Thank you, Arthur. I see another question here from Chris. With the cessation of the agricultural season in Latin America, are you expecting all subsequent new build VLCC maiden voyage shipments to position themselves away from West Africa and subsequently no more STS Lome shipments? Well, that's a great question, actually. And yes, I believe by seeing lower diesel demand stemming from Latin America, I believe we're still going to see these STS Lome shipments from West Africa. We might see some direct products going into Europe where we have elevated diesel crack spreads. But what we might see is also these STS movements have as an ultimate destination instead of Latin America, Europe as a final destination for the remainder new build VLCC voyages.
Great answer, Yanis. Thanks. I'm going to take one from that we got in the private chat. Has oil peaked? Now, the assumption, was always that demand was always going to grow. Obviously, the COVID pandemic was kind of a black swan event. And when we thought that oil consumption was going to peak, it'd be so far into the future that it wasn't worth thinking about. And that implies also the fact that oil always had and will always have this sort of permanent monopoly on shipping. I don't think any of that is true anymore. I think oil and especially natural gas, they're going to remain parts of the energy mix for a very long time, but it's going to be a very different mix. Renewables will now take a large part of that. Hydrogen will emerge as well, alongside potentially other sources. Why not imagine carbon carriers in the not so distant futures as well? So it's not going to be an oil age, it's going to be an energy mix age. And I hope that answers the question.
Perfect. I see another one on the private chat, which I think is worth answering. The question is, what is your view on the East of Suez LR tankers? Well, I believe that the LR segments could be on the spotlight this winter. That doesn't happen oftenly, at least based on demand fundamentals. So an open arbitrage towards Asia amid strong petrochemical demand, has driven up naphtha cargoes towards the east. And we also witnessed during the summer a seasonal trend where LPG was actually priced at a premium to naphtha, which is not usually the case. And, this discount of naphtha to LPG is generally poised to continue as we proceed towards the winter, where seasonally LPG prices will be supported by the pickup in heating and cooking demand joining the petrochemical sector, whereas naphtha prices, maybe after the cessation of the US summer driving season, could ease relative to a weakening of gasoline blending activity. Hence, these appealing naphtha prices could keep trade volumes high, but there's always a but these days in shipping. On the supply side, nevertheless, if we do not see a strength in the crude sector, we will possibly see a resumption of the LR2s cleaning up, and also the return of European refineries, as we said earlier, could slash this LR employment that we said that moved from east of Suez to west of Suez diesel cargoes, and could instigate more intra-regional MR tanker moves, which actually will bring more LRs replacing, actually looking for employment. So these two factors could act as an equalizer to any considerable increase in rates.
Thanks, Yanis. There was the second question here in the public chat from Unmesh. What are the primary drivers for an increased freight rate year on year? So we covered demand in this presentation, and that's looking bleak in terms of supply available in the market to be moved around. But I think it's important to answer that question because it allows us to talk about the supply side of the equation, which is how many tankers will be on the water. We're unfortunately going to experience a phenomenon called slippage, which is when tanker deliveries that were planned for 2021 are going to be pushed back to 2022. So what does that mean? Well, it means that fleet growth for 2022 is probably going to be closer to 3.2%, according to market participants. And that actually compares to 1.8% this year. So we're actually going to have more tankers delivered next year, so which means more actually tanker capacity with the lack of scrapping than before COVID sort of destroyed freight rates. So you add those two together, that's sort of adding further doom to the gloom there, especially on the larger tanker sizes, so VLCCs and Suezmaxes. Only talks between the US and Iran and the removal of sanctions, like we mentioned previously, could sort of kickstart those scrappings. But these talks have been paused since June. There's 2 new leaders in both of these countries, so we're not sure whether they'll be resuming anytime soon. I think we're running out of time now, so I might close the webinar off now. But we'll be answering the questions that we haven't had a chance to answer by email. So thank you everyone for attending. There's our email address there as well if you'd like to get in touch with us with questions with regards to this webinar or anything else you're curious about. There's going to be a small survey on the screen once the webinar ends, so please feel free to provide the feedback. And just to remind everyone, there's going to be a recording of this session available with the slides sent to you in the next 24 hours. If you want to see where we get our data, how the platform works, please feel free to request a demo on our website at vortexa.com. Thank you, everyone.
Thank you, everyone, for attending.